Yeah.
30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, retail results ramp up. Target gets a new CEO while Lowe's makes a big deal. Tech troubles. The Nasdaq struggles to recover from its second biggest one-day drop since April's tariff shock, and suspense builds for Powell's Jackson Hole speech as the Fed chair faces challenges on multiple fronts, not the least of which is the president calling for the resignation of yet another Fed governor.
Yeah, we'll dig into the drama there. Let's talk about Hertz, though. Absolutely soaring this morning on a report that the car rental company will start selling pre-owned cars on Amazon Autos, not a platform that I knew existed, but maybe you did, Matt Miller.
You know what? I haven't thought about that a lot lately, but I did know that Hertz wants to make a bigger deal out of selling cars, not just renting them. There are a ton of retail earnings this morning. Target announced a CEO change and an outlook that has investors on edge. Lowe's earnings topped estimates and announced it will buy foundation building materials for $8.8 billion in cash. And finally, TJ Maxx boosted its earnings outlook as discounts lure shoppers, which is, I mean, that's their whole model, right?
To lure shoppers.
With discounts.
You're right.
That's why you go to TJ Maxx.
That you're correct in that. Let's dig into this morning's retail earnings. We're joined now by Bloomberg retail reporter Lily Meyer. And I actually want to start with the stock that was in the middle there, Lowe's. Really interesting to see them come out with earnings. Also rising, though, even after they announced that they're going to buy a foundation building for $8.8 billion in cash. Usually you see the acquirer fall in such a situation. Not today, though.
Yeah, not today. And Lowe's is really leaning into its pro market. So it's making acquisitions to cater to more of contractors and more of the professionals who shop there rather than the DIY shoppers.
So Target is putting a new CEO in place on, I think, really the perfect day, because Matthew Boyle has a story on the Bloomberg about the costs of replacing a CEO. It's an amazing story, and it can be a tremendous cost. Why are they replacing the CEO?
Yeah, so Target has struggled for a while. It has struggled to compete with Walmart. It's struggled to have that kind of fun factor that brings customers in. And so it's not super surprising that it's replacing its CEO, but I think the street fell because maybe they were hoping for an outsider to run the business.
I feel like I should ask you about TJ Maxx, but I actually want to go back to Lowe's because you mentioned that buying foundation building, it's all about deepening their relationship with more of the professionals rather than the DIY. That's interesting because it feels like Home Depot has really focused on that.
Yeah, Home Depot has focused on both, so it's also made some acquisitions to get more of that professional customer, and normally they buy more and they shop more often.
I will ask you about TJ Maxx. I mean, obviously, the whole model is luring shoppers with discounts. And I guess it's doing better than the street had expected?
Yeah, so they reported really good earnings, and, you know, it's a really good time for discount retailers. Consumers are feeling concerned about the economy and looking for lower prices, and so TJ Maxx fits perfectly within that.
All right, Lily Meyer covering retail for us. TJ Maxx shares, by the way, I'm looking at the last 5 years, have almost tripled in that time period. So I guess it's been a good time for discounting for a while. Another stock we're watching this morning is Toll Brothers, the luxury home builder, sinking as weak demand weighs on quarterly earnings. Bloomberg's equities reporter Nora Melinda, who also covers the housing sector for us, joins us on set. So what's the story, Nora, with Toll Brothers?
It's still a weak situation here right now. Of course, we're seeing weakening demand that we're really discussing here, but the story here is really uncertainty. Of course, when you reflect on last quarter here for Toll Brothers, we're talking about a trade war that's really what has been front and center for a lot of people. When you look at the unemployment data, of course, that seems to be cooling a bit as well as we think about what the job market is looking like right now. So you have a lot of people who are really trying to grapple with, is now the time to buy a home? Is now the time to buy a luxury home? But it is important to point out the fact that we do still have a lot of those people who are well off and they're able to still pay down a lot of these houses from Toll Brothers in an all-cash transaction. So they're not necessarily having to take out a mortgage loan here. But when you look back at the last quarter, we saw mortgage rates that were sitting at about 7%. So pretty hefty deal there, and you're seeing that reflected in the trade today.
Well, it's similar to the conversation we were having around Home Depot yesterday. Sort of the takeaway from that was that, okay, the housing market is kind of stuck right now, and you're seeing that reflected in some of those DIYers that shop at Home Depot. So Toll Brothers, you think about the personality of these different home builders. My understanding is that Toll Brothers, it's more move-up buyers. Maybe they're not first-time home buyers. Maybe they're selling their previous home. What does that say about the rest of the home building landscape?
Most definitely. So Toll Brothers does focus more on affluent buyers, but to your point, they also do have move-up buyers that are looking to get a second home. And in some situations, this is a discretionary situation. So maybe they don't need this home at the current moment. So some people are kind of putting that off for the time being and waiting until rates drop, until we see the Fed potentially cut later this year or into the next year, 2026, to really make a big purchase such as this. But I mean, you do still see people out there that are using cash. You know, they're liquidating their portfolios and getting out there and putting all the money down. But I mean, it really does show just the broader landscape of how challenging things are. I was looking at a stock, James Hardie, and they're essentially a building materials company down for double-digit losses right now, down 28% in pre-market trading because of also them having this dramatic miss. So it really is just underscoring all the complications that we have right now in this lock market.
It is brutal.
It is
there.
stuck.
Yeah.
Is that an Olivia Rodriguez call out?
No, it wasn't. It was just me talking about my experience trying to buy a home.
Hey, you could have gone with it.
Yeah, that's true.
I
would have believed.
I
Not
like
a
it.
huge Rodrigo fan.
Rodrigo, there you go. Norma Linda, thank you very much. Excellent to have somebody from the equities desk who also watches housing. Housing is stuck. We've been talking about that on this program for a while now. The Nasdaq 100 is also kind of stuck right now, struggling to recover from a sell-off yesterday led by Nvidia. Let's talk about that as well as Intel's recent surge with Bloomberg Tech's Caroline Hyde. Caroline, what happened to Nvidia yesterday? We started to see it sag in the early minutes of trading, and by the time we closed off the show, it was down more than 2%.
And you saw AMD off by 5%. You saw Palantir off by almost 10%. We are starting to question the valuations for a moment. Whether or not that's the macro policy, we all await what's happening with Jay Powell, whether or not we start to question valuations in the private market and that seeps into the public market, or more broadly, you're just thinking like slightly lower volumes mean we're going to have these bouts of volatility. But at the moment, we are starting to see some of the bigger tech names that have run up in the last few months just get some profit taking happening overall, particularly in the chips names. And it was interesting that, of course, while Intel has been outperforming, the rest of the market has just been perhaps putting back. We've got Nvidia's numbers coming next week. Maybe there's a little bit of anticipation going on there too.
Yeah, absolutely. Have to imagine that'll be a catalyst. It'll be interesting to see whether or not yesterday was a one-day rotation, but you did see big tech fall. You saw bonds rally, so maybe some profit taking going on in the sector. Let's talk about Intel a little bit more.
Yeah.
We've been talking about it for several weeks now. Matt has been making fun of the fact that, you know, it's just cracked $100 billion
Whoop, whoop.
in market cap, which isn't very big in the grand scheme
Versus
of the
your
tech
$4
sector.
trillion on
Exactly.
Nvidia.
Not as big as
Exactly.
Palo Alto, for example.
But you
Context.
take a look at the valuation of Intel. It's trading, what, at 50 times projected profits? That is the highest since early 2002, Caroline.
Since the dot-com era.
Yeah.
I will just say Palantir's trading at 200 times.
Well, that is just silly,
Future
Susan.
earnings. So we've all got
100
the
times
perspective
sales.
there.
Yeah.
But look, Intel hasn't been this richly valued since the dot-com era. It is a really nice piece of work that Ryan Fiddelke has been writing about the fact that we've got $24 billion added in the last month alone to the valuation. We're up 28% there or thereabouts. We might pull back a little bit today, but this is a lot of hope being baked into what's going to happen. And you've got kind of a dichotomy of ideas here. On the one side, the optimists, the idea that maybe you get a 10% holding come from the government, maybe you get SoftBank coming in and buying $2 billion stake, maybe this galvanizes people to believe in Intel's future, and then they start ordering chips from them then going forward. But on the flip side, you've got others saying, is the government holding a stake in a company always that positive for a fiduciary duty perspective and for profit holders more and in shareholders more broadly? And will this actually bring demand? Because ultimately that's where people have been questioning the innovations happening at Intel and whether you want to be buying and making your chips with Intel versus TSMC. But for now, we've seen a phenomenal run up, 53 times future earnings, and we'll see as to whether people really want to be buying into the stock at the moment. Some are now questioning. Most analysts have said sell the stock, and indeed, most of them have a price target that is below the current level.
Well, you bring up what I think is a key question, whether or not the government as a fiduciary, whether or not you want to invest in that company. We were talking about my ETF idea, where you just buy up those sort of companies, might not actually be the trade.
Well, there are a lot of models for it around the world, right? If you look at the Kreditanstalt für Wiederaufbau in Germany.
Beautiful. Did you know this? Anyone know this guy who still lives in Germany?
You know, a lot of countries have these investment funds that are for lifting industries that they think are relevant to national security. And
what, like China as well?
For example, and by the way, I was talking with or emailing with Winston Ma from the China Investment Corporation. He's also an adjunct professor at NYU, and he says this is the start of Trump's sovereign wealth fund that he talked about so much. Joe Kaiser over at Mercado said this is the Trump administration's own VC effort. Are you hearing people say stuff like that?
I think people are wanting to see whether the government is going to be all in on defense tech, as we started to see a lot of people calling to invest in European defense names because we've got a similar vibe going on there. I think the questioning is, though, also why is money also being incentivized from the Middle East? Initially, we've seen, well, SoftBank come in, but Middle East money was what was thought perhaps would be used to prop up an Intel or the like. But the fact that really it's the US government that wants to back US winners when it comes to generative AI, when it comes to the military applications, I think that is something that we're starting to hear far more, that government's playing a way more active role in corporate governance and corporate business than we ever anticipated. Although remember how LookNet yesterday did say, we don't want to make any decisions at this company. We just want a stake in the equity.
True. But it does seem like that's the direction of travel. Caroline, great context as always. That is Caroline Hyde. She is the co-host of Big Take. You can catch her at 11 a.m. Eastern. But let's take a quick check on futures right now. We're 20 minutes out from that opening bell, and you can see, boy, it's quiet once again. That seems to be the theme of this August week. The S&P 500 down about 0.1% pre-market. The Nasdaq 100 still nursing losses in the pre-market. We know that yesterday was a wipeout, though, for those techniques.
Yeah, you know, you've been saying wait and see a lot this week.
I have.
Obviously, traders tend to do that, especially on, for example, on Fed Day. You'll see them turn off the algos, sit on their hands until they parse through the statement. This is like Fed week, right? Because we had Jackson Hole on Friday. And WIRP, the World Interest Rate Probability function on the Bloomberg, is still showing an almost 85% chance of a rate cut in September. The question is, after that PPI inflation data, does the market really buy into it? Are we really going to get that, or could we be caught wrong-footed after this?
Right, and I mean, does Chairman Jerome Powell want to rock the boat? It seems like the consensus is that maybe he won't say too much about monetary policy, but it is his last Jackson Hole symposium as Fed chair, so who knows? Yeah.
All right, we're going to talk about cars when we come back.
Of course.
And we have actually a few car segments here, so get excited. Hertz reportedly partnering with Amazon to sell used cars. More on that next. This is Bloomberg Open Interest. Let's get now to high interest. Look what's making headlines around the world. Estee Lauder is expecting sales to increase this year. It's an early sign that its turnaround plan is starting to work. The owner of La Mer and Clinique is trying to sell more products on Amazon and TikTok as it pivots away from its reliance on department stores. And Lazy Boy shares are tumbling in pre-market trading after posting weaker than expected earnings and issuing a downbeat outlook. The recliner company citing slower foot traffic and weaker sales at its Joybird brand. Thoma Bravo is in advanced talks to buy the HR software provider Dayforce. We were talking about this yesterday. It would be one of Thoma Bravo's largest ever deals. The private equity firm is discussing an offer of $70 a share for the Minneapolis-based Dayforce. That would represent about a 32% premium for the company. And Guess, the iconic jeans brand of the 1980s, will be taken private by Authentic Brands for $16.75 a share. That's about a 73% premium for the apparel company. Authentic's portfolio includes Champion, Reebok, Eddie Bauer, and Brooks Brothers. It's a true flashback portfolio.
A diversified portfolio, too. Let's talk about Hertz, though. I know that you're eager to get to this story, Matt. Shares in Hertz rising in a big way after a report that the car rental company is partnering with Amazon Autos to start selling secondhand cars online. You can see that Amazon shares not reacting much. Hertz up 12% pre-market, and Carvana also dropping. Let's unpack it all with Bloomberg's Detroit bureau chief David Welch. So this is interesting from Hertz because, again, I called them a car rental company, but in this pact, they would be selling the vehicles, David.
Yeah, look, they've been selling vehicles for a long time and really pushed the retail side of it the past 6 months especially. They've got Tom Brady as a pitch man. They're doing more with their own division that sells cars online. And by partnering with Amazon, just driving more eyeballs to the inventory that they've got out there, getting more people to give them a look and trying to boost sales even more. And the reason they do this, rental car companies, they can go to auction and sell used cars, but they get pretty poor pricing by doing that. If they go retail, they get much better pricing, and the more channels you got, the more cars you can move at a better price.
Amazon, though, you know, this is a place where I buy like Chinese knockoff goods for $25, not whole cars. How would that work?
Basically, Amazon, people go on there, they'll serve inventory on cars. A lot of franchise dealers already do this. So you find the car and you work out a deal to buy it from the dealer typically. So in Hertz's case, Amazon doesn't buy the inventory, they basically list it for them. So you know, it's basically, I wouldn't call it lead generation, but it's getting inventory in front of people who are shopping for cars. Amazon hasn't been huge in this. They're starting to push more into it as well. Other websites, I think, have been a lot better at doing it. But I think for Hertz, it's a smart move because they're just finding ways to find more retail buyers to look at their inventory.
I see. So it's like, I mean, Car Gurus, Cars.com, Auto Trader, where you click through to Hertz or you click through to your local dealer. It's not as if Amazon handles delivery and the guarantees and whatnot. So it really is kind of a lead generator.
Kind of is. And look, Hertz is starting with this in 4 cities. Eventually, they want to get to the 45 or 48 locations they've got where they're selling cars at retail. And look, there's a lot of competition out there for retail sales, obviously online. Obviously, there's Carvana doing this. The sites that you mentioned, you know, Lithia Auto, the big dealer, they're very good at retail sales online as well. And it's a very big, very diversified market of selling used vehicles online and you know the used car market in general. But if you look at Hertz shares this morning pre-market, we'll see what happens at the open. There's a pretty heavy short interest in Hertz, so a little bit of news goes a long way in terms of pushing the price up. But you know this is part of Hertz really pushing this agenda of getting better pricing for the cars that they've been renting when they go to sell them. And I think we'll probably see more deals like this from them in the future.
All right, David, really appreciate your time. That is Bloomberg's Detroit bureau chief, David Welch. Really interesting story when it comes to Hertz. David, of course, mentioned that short interest. We know that shares have really staged quite a rally year to date, up 42%. But you take a look over the past 5 years, as we often do here on Open Interest, they're down still about 80%. So it's been a good year, but coming after several pretty bad ones.
Well, someone famous took a big stake.
Yeah, I heard that.
All right, we'll continue to talk about this company. And then later on, we're going to talk about Ford, the Ford Motor Company as well, because they may come out with super high-end, like $300,000, possibly limited supercar for off-road, like a GTD in the dirt. I'm pumped about that.
I know you're pumped about that. But even before we talk about Ford, we're going to speak with Robinhood's Stephanie Guild. She remains confident in her year-end call for the S&P 500 at 6,500. We'll discuss how she's factoring in tariffs and AI in the labor market. This is Open Interest. Megacap tech stocks are the most underowned in more than 16 years relative to their weighting in the S&P 500. That is according to Morgan Stanley. And specifically, Nvidia was the most underowned large cap tech stock among institutional investors at the end of the second quarter, according to that report. Let's get into it with Robinhood Chief Investment Officer Stephanie Guild. She joins us at the desk. First things first, it's great to see you.
Likewise. Happy summer.
Happy summer to you. It's almost over, sadly. Let's talk a little bit about positioning here, because we have the institutional snapshot. Apparently, they're underweight Nvidia. What are the retail traders on Robinhood's platform doing?
They are still doing the thing that they do, which is tend to trim their winners and go into things that go down. So, for example, over the last week, CoreWeave was on the buy side, and AMD, for example, like in the chip space, was on the sell side. I have seen an uptick a little bit. So ETFs tend to be used more so when there's a big dip in the market, which we obviously haven't had. Maybe yesterday you could call one. But I did see an uptick in that, and it's actually been more in places like ETFs that tend to use options to generate income.
Right.
Which is a different take.
So when you see a dip, and I mean, yesterday wasn't extreme, right? We had
1 point something on the Nasdaq 100.
True, 0.6% on the S&P 500.
Yeah.
Do you see them buying the dip with those ETFs?
It wasn't, not so much yet. I think you've tended to see it more on the single stock basis. And so I think also our customers are like used to volatility. They don't buy the things that are like slow and steady. You don't see a big buy in consumer staple names. Like it's a much more, Mag 7 tends to be like in our Robinhood Investor Index, so Mag 7's around 45%, although that's been falling a little bit. And then you see it in some of the smaller names, like I mentioned, CoreWeave, right? BMNR was on the buy list as well, which we've seen some other portfolio managers start to invest in.
Interesting. So you say that, the investors on your platform, they're used to volatility. It seems like listening to some of the names you mentioned that you could make the argument that they're actually seeking out volatility too.
Yeah, I think you see that. I mean, and certainly on the option side, like you need volatility to kind of make money, right?
And have fun.
Yeah, sure. I mean, but I do think, like, especially, we do have a customer base that has been investing in crypto for a long time. Right. That does not lack volatility.
BMNR is
Bitmine immersion.
Bitmine immersion technology.
Yeah.
I'm looking at the chart.
Yes.
It's pretty fascinating. I can't believe it's a $9 billion market cap.
I know. Well, and you've seen the likes of like Tom Lee and Kathy Wood make investments there. So it's it's certainly something for the longer term future.
All right, Stephanie, you're going to stay with us. We're going to broaden this discussion out beyond Bitcoin immersion technology, Bitmine, sorry. A check on futures ahead of the opening bell after the drop that we had yesterday.
It's quiet. There it is.
They're down. This is Bloomberg. We are moments away from the start of trading on this Wednesday. This is Bloomberg Open Interest. I'm Matt Miller. We're seeing another dull day in futures where S&P futures are down. There are red arrows really across the board, but there's just not a lot of movement here. 0.1, 0.2%. You hear the opening bell, and we've got a publicly traded company on the New York Stock Exchange again. This is Big Bear AI. They went public via SPAC in 2021 and have lost 44% of their value since then. Down on the Nasdaq, you've got Chimera, which is, I guess, a biotech company that has done okay this year, up about 5% over the last 5 years. They've more than doubled, so a much happier investor base for sure. In terms of the stocks to watch, we're really focused today on retail earnings.
Absolutely, and there's a lot to talk about here. We have Target announcing a CEO change and an outlook. You add it all together, investors clearly on edge. The stock getting decimated at the opening bell, down about 10%. Lowe's a different story and an interesting one. Its earnings topped estimates, and the company also announced that it will buy foundation building materials for $8.8 billion in cash. Shares up about 4% or so. They're really focusing on the professionals here rather than the DIY set, and shareholders seem to like it. TJ Maxx, really interesting. They boosted their earnings outlook as discounts lure shoppers. Matt, you pointed out that that's the whole thing. That's the whole business model. What's really interesting is that you take a look over the past 5 years for this company, absolutely crushing it, up over 170% on a total return basis.
Yeah, TJ Maxx actually beating out every other big clothing retailer I could put up against it.
And the S&P 500.
Yeah, doing very well. So I don't know who I would cross shop really with TJ Maxx. We were talking about Loehmann's. I'm not sure if that exists anymore.
Yeah.
Kohl's is a big loser compared to TJX, as is Nordstrom. So
Everything is.
Very interesting moves there. Hertz is surging today on news that the car rental company will start selling pre-owned cars on Amazon Autos. You can see another 12% gain here. Earlier this year in April, Bill Ackman took a 20% stake. Our friend Tom Wagner owns and runs this company, Nighthead Capital. So it's a really interesting story because Hertz had done so badly after buying like 100,000 Teslas. Turned out to be a horrible strategy move. But they're trying to move past that now. They've sold a lot of that inventory. They're building up new inventory, and they are making a big deal about the fact that they don't just rent cars. They also sell them.
And specifically, they're going to start selling them on Amazon Autos, which is interesting. Again, I didn't know that existed, but apparently Costco has a similar model as well. So learning a lot this morning.
Yeah, about cars. We'll continue that a little bit later with Ford, the Ford Motor Company. I interviewed Jim Farley over the weekend, and it was fascinating. But right now, we're going to get back to these markets. Robinhood Chief Investment Officer Stephanie Guild is with us. And it does feel like, Stephanie, everybody's kind of sitting on his or her hands waiting for Jerome Powell to speak at Jackson Hole. How pivotal or how important is this speech? Could this speech be?
His speeches are always important, but I feel like so much is already built into expectations of Fed rate cuts. And
we all expect a cut in September, right? No matter what inflation numbers
the market's 85%. I guess it was a little higher like last week, but yeah, we're all expecting that. And obviously some things this morning makes it seem like it's even more possible to happen and for the whole Fed, all the Fed governors to slowly become dovish. So I don't know how much more he can say. Like I think given those expectations, there could be a chance that he says we still care about inflation and the labor market isn't weak enough for us to care so much about that.
It's interesting. You think about that 85% pricing that's in for September. Maybe it was closer to 90% a little bit ago. It was really solidified after we got that labor market print for July, really ugly. And also the revisions caught a lot of people by surprise in a bad way. But you write in your notes that inflation should still matter more.
I think for right now, because I think if you look at I think we got a little spoiled, right? Like I think everybody always, it's about frame of reference. And we had 600,000 jobs added on average coming out of COVID. And then it got cut in half and cut in half and cut in half. And to have not a lot of jobs being added now kind of makes sense. And I think the revisions were a function of the fact that we weren't really funding data collection in the BLS and probably needed to use more technology and things like that. I mean, they still start with a phone call. So I think, but I am worried about the labor market simply because if it doesn't come out in inflation with higher prices from tariffs, it could just come out with cost cutting. And cost cutting means probably, rethinking the way your labor market works, the way your own employee set works. And the CEO, Conference Board CEO, confidence measure, I think it's called, said there's actually, we saw a tick up in less hiring, at least. I think it was like 34%, which is like the highest since 2020.
I wonder how the labor market affects retail trading, and you obviously have a great vantage point for that. I mean, if people lose their jobs, do they trade less? Are they sitting at home and trading more? What are you seeing in the data from Robinhood?
Nothing's really changed. I mean, you're definitely seeing continued growth.
Because we still have unemployment at 4%.
Yeah, I mean, right, exactly. Like it's still a relatively full labor market. And you see data from places like JP Morgan, Chase, and Bank of America where they show you like savings on average, and it's still above the 2019 levels. So the consumers continue to spend. We are seeing an increase in credit, right, and people taking on debt. So that is something to worry about. But we haven't really seen any major issues in terms of our customer base.
Interesting. And we've talked about single names. We talked about CoreWeave. What about at the sector level? I mean, what is the thinking around specific sectors, specific industries, as we talk about these different cross currents when it comes to the labor market, when it comes to trade policy, when it comes to corporate earnings?
Earnings have obviously been resilient, but I do think everyone was saying, oh, Q2 earnings were so amazing, but expectations had come down dramatically. Yeah. And where earnings growth ended up was where earnings growth expectations were prior to Liberation Day. So I often wonder, were they really that good, or were they just where they should have been expected to be. From a sector and space perspective, we're preferring GARP names, and we started seeing this rotation in July.
Growth at a reasonable price.
Growth at a reasonable price, which means that we're not necessarily owning like the highest momentum names, and we want to make sure we have allocations to things that maybe have been a little bit left behind, either in the tech space. We like aerospace and defense, although that's been a little more wobbly lately, but I still like it longer term. And GARP, as an example, like J&J, that sort of, I think under the current, like they still have some stickiness, obviously, with their past, but it's 16 times next 12-month earnings. They have a bunch of stuff coming off patent, but that tends to be something that's like rear view. They're investing a lot in the U.S., which is a good, favorable perception, at least.
With this administration, that's an interesting one, J&J, because it's been really tepid in terms of performance over the last 5 years, but crushing it this year, up about 25%.
Yeah, I mean, that's why we it just felt like it had all the pieces, and they have enough leverage in their balance sheet to maybe make some acquisitions, which perhaps M&A, we're starting to see it tick up.
Yeah, definitely, and especially when it comes to J&J. They really kicked the year off when it comes to healthcare M&A. Steph, it's great to see you again. Great to get some time with you. That is Robinhood Chief Investment Officer Stephanie Guild. Let's get a check on these markets. We're just about 8 minutes into the trade today, and you can see not really bouncing back from that decline that we saw yesterday. The S&P 500 down about 0.1%, even though you have fairly good breadth right now, more than 300 names in the green, but you have some of the tech names declining. Let's talk about the gainers to start, though. Up at the top, you have TJX. That is your biggest points contributor to the upside right now. We know that earnings certainly impressed investors. That's your biggest gainer. JP Morgan, though, also punching higher, as too is Berkshire Hathaway. This is interesting. We've been talking about the stake that they took in United Health. United Health has had a fantastic month. That's probably going to be eventually good news for Berkshire Hathaway as well. But let's take a look at some of the losers today. Nvidia is up at the top, and this is the problem. It's down 1%, but it's so big that it's really dragging the index with it. Apple, too, isn't helping, nor are declines in Meta.
You got the whole Mag 7 over there.
I know. It's ugly out there, Matt, and that's what you're going to see at the sector level as well. Let's take a quick look at that on this down day in the market. Again, breadth looks good right now. You have more green than red. That's typically a good sign. Consumer staples at the top, energy, real estate. These smaller companies, these smaller sectors are doing all the work today. But then take a look at this bar. It goes all the way out over here. The tech sector down 0.7%, bringing down the whole index because it's hard to fight against that influence.
Yeah, absolutely. It looks like all of the stocks in the Mag 7 on the downside this morning, and that's tough. And then we have Target also. We're going to talk about that coming up. Those shares sinking as the company announces a new CEO. We're going to talk about the retailer today, and we're going to talk about the cost of switching out CEOs. It can be incredibly expensive and not necessarily yield amazing gains. This is Bloomberg Open Interest.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Nubank is getting a double upgrade over at Citi. The analyst says that the bank is able to accelerate in key portfolios while maintaining good asset quality. That's all good news for Nubank, up about 3.7%. Next up, JP Morgan is assuming coverage of Albertsons with a buy rating. The firm also started coverage of 24 stocks in the food universe, with the analyst saying that food producers are dealing with slowing growth, while food retailers should benefit from the continued inflationary environment because you have to buy food. And finally, the Gap is getting downgraded over at Citi. The firm expects an earnings beat when it reports next week, but says that the company does not have enough pricing power to offset tariffs. Shares up very marginally today.
All right, so those are some of the upgrades and downgrades. We're looking at another retail, a name that is guaranteed to get a lot of action today is Target. The company picking COO Michael Fiddelke to become its next CEO and turn the company around as Brian Cornell steps away. Shares are plunging on the report. Joining us now is Paul Lejuez, senior analyst at Citi Research. He has a neutral rating on the stock with a $94 price target. And Paul, I just wonder your take on this insider at Target. He's been there since he joined as an intern in 2003. Is he going to be enough to upgrade your rating to a buy?
Well, yeah, he's been there for over 20 years, and I think the market was maybe hoping for an external person to come in and take that role. So obviously, we're seeing some negative share reaction today. I think most important for us is Target has been losing market share for several years now, and so fundamentally, what we'll be looking for is, can Michael Fiddelke do something to change the trajectory of Target sales, which have been by far underperforming that of Walmart and Amazon and Costco, some of the winners of retail.
It can't be a vote of confidence, though, to see the stock down so much today, Paul. Is this more to do with the earnings themselves or the appointment of this new CEO?
Well, it's a little bit of both. I think for sure there was an aspect of the market wanting to see an external person take that seat. But at the same time, same-store sales were still down, and they've been down for several years now, at the same time as we're seeing sales increase at other retailers. And so today's report was a reminder that Target is losing market share. They said the same thing that they said on the first quarter call, that they are losing share in more than half of the categories, the 35 categories that they track. That's a similar comment they made in the first quarter. They said it again today. And I think it just highlights some of the challenges that they're facing.
What's the biggest problem at Target? Is it just not as prevalent, as ubiquitous as Walmart? Do they have a rep for maybe a slightly higher price point? Have they not kept up the look of their stores? What would you put it down to if there was one thing?
Well, it's hard to pinpoint one thing, but I think it's certainly they are losing market share to Walmart. Walmart is winning, and that's been a theme of ours for several years now, and we can't dismiss that, because when you have a retailer as large as Walmart increasing their sales as much as they are, those dollars have to come from somewhere. So I would say if I had to pinpoint, it would be that Walmart is winning, that they're a force in retail, and Target has been on the losing end of that.
We should also talk a little bit about TJX reporting this morning. And you can see that these results are being welcomed in a big way in the stock market. Shares currently up about 5%. When it comes to this specific quarter, if you weren't following this company closely, you could say, OK, maybe they're benefiting from a trade down right now in this current environment. But Paul, this is a story that has been working for a long time, at least when you take a look at how the shares have performed.
For sure. I think, when we look at the off-price sector in general, TJX, Ross Stores, Burlington, that sector has been taking share within retail for several decades. And I think the current environment is very ideal for them. They have mind share for value. Customer clearly is voting by showing up at their stores. Traffic has been very strong at the off-price group, especially TJX, for some time. We think they're a winner in the retail landscape. And this tariff environment is very disruptive to the world of retail. It's difficult for retailers to plan their business. You're going to see a lot of cancellations. You're going to see a lot of retailers make mistakes. And the off-price sector is very good at taking advantage of those mistakes and continuing to drive traffic. And again, mind share for value is what they represent. And we think that's really working in the current environment.
I want to ask about Abercrombie and Fitch. I thought they were in the middle of a turnaround. Urban Outfitters, The Gap, these are all stocks that you downgraded today. Do they have a common problem?
Yeah, I guess I would say the common theme is, specialty retailers generally on the apparel side, I think will have a difficult time passing through price to the consumer. Abercrombie has certainly, I think, executed one of the greatest turnarounds in retail history. This year has been a little bit tougher for them. But I think if you look at the common threads, everyone's going to be facing slightly higher tariffs than when a lot of these companies last gave guidance. We don't think there's a lot of pricing power within apparel. And we think it's going to be a difficult setup, not just for the back half, but even as we think about 2026, some of these tariff impacts are going to carry over into the first half of 26, just based on lead times and the timing of when tariffs are going into effect. And we think it's going to be a challenging next couple of quarters for specialty apparel.
All right, Paul, great to get some insight on these earnings from you. That is Paul Lejuez of Citi Research. And Matt, you mentioned Abercrombie and Fitch. Shares down 38% this year, but you think back to the past 2 years they had higher by 285% in 2023, another 69% higher in 2024. It feels like they did the turnaround and now we're coming back.
Absolutely. I mean, I'm looking at the shares right now. Over the last 5 years, Abercrombie and Fitch is up 817%.
It looks like a meme stock.
Yeah, it absolutely confused me when I pulled it up. I put it against TJ Maxx, which is up 193%. Ross Stores up 80%. Burlington up 48%. But ANF, obviously, it's a very different store than those three. Up 817%, outperforming Urban Outfitters, which is up almost 300. So it's quadrupled, but Abercrombie just stomps it. Really, really interesting stuff.
The better comp would probably be American Eagle, but we know that American Eagle, the stock has been moving on a lot of different factors right
I didn't even know it still existed.
American Eagle?
That was like when I was a kid.
I bought
when people were listening
two pairs of jean shorts there 2 weekends ago.
Shorts, huh?
Yeah, they're back.
I didn't know that was a thing either. Well,
anyway.
Interesting.
We should probably talk about
Maybe
AI.
I'll get some.
Yeah, maybe. Let's talk about AI next, because AI deals powering a turnaround at Oracle and making Larry Ellison the second richest person in the world. We'll talk about that next. This is Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Let's take a look at what's going on in stocks today. We do see the S&P continuing to fall and falling further now. Another 0.5% drop here to 6378. We're coming down from essentially 6,500. So we're actually losing ground. On the Nasdaq as well, down more than 1%. As Katie showed you earlier, we have almost all the Mag 7 down, including Avgo. So Broadcom would make it the Mag 8, and that's a big loser today as well. The Russell is a loser, but the Dow Jones Industrial Average holding steady with all cyclical and industrials on it. Nvidia is one of the big problems, down 2.6%, and Tesla off more than 2% as well. We do see Toll Brothers. We were talking to Nora Melinda about the home builder earlier on results, actually doing a little bit better, and TJ Maxx continuing to add to the gains that we've seen over the last 5 years. That stock has tripled. Intel, like the curse of the cover, as soon as we start talking about how well it has been doing, it's off 6%. And Oracle, which we're going to talk about right now, also down 2.33%, Katie.
Yeah, well, it's a down market, but Oracle shares, they've risen about 40% year to date. You think about why, and a lot of it has to do with the tech giants' change in fortunes, and they've been powered by major deals with AI heavyweights Nvidia and OpenAI. Bloomberg tech reporter Brody Ford joins us right now. So there's those deals for sure, but there's also Larry Ellison's change of heart in general when it comes to the cloud unit of this company.
Very famously, 2008, Ellison is on stage saying the cloud is gibberish. I'm not sure we really want to be in this business. And because for a long time, Oracle made money by selling its famous database and installing it right on your servers. And so they didn't want this business model where you're selling computing power over the internet. And Oracle was kind of this wayward, tech giant of a previous generation. And that's really changed in the last couple of years with the AI boom.
So who are his biggest customers? I mean, where's the money coming from, feeding into Oracle and helping the shares rise and Larry Ellison's bank account as well?
So yeah, I mean, Oracle, it's going to be that OpenAI is on track to be the largest customer by far, right? It's going to be that, cloud infrastructure will be the largest portion of the business. And that's because earlier this year, we saw at the White House, they had the, Larry Ellison was standing there.
The Stargate meeting.
Yeah, the Stargate meeting. And, so the question now for Oracle is, can they fulfill on all this? We have some details on how they are making some very drastic steps to try to build out big data centers quicker than have ever been done before. And so the jury is somewhat still out on whether they can fully capitalize on the demand.
It's a great story, and I recommend everyone read it on the terminal. Brody Ford from Bloomberg wrote that piece on Oracle and the change of heart that Larry Ellison has had, which helped him become the second richest man in the world. Coming up in the next hour, strategist Matt Maley joins us from Miller Tabak. Morgan Stanley economist Sarah Wolfe, plus the CEO of Udemy on AI impacting the next generation of workers, finding it maybe tough to get a job out of college. Then Michael Baker joins us from D.A. Davidson. It's a full show. We're going to talk about Ford's potentially $300,000 off-road supercar as well. This is Bloomberg Open Interest. All right, we are 30 minutes into the trading day. We continue to see red arrows and the drops get bigger and bigger as the Mag 7 fall. I'm Matt Miller. This is Open Interest.
And I'm Katie Greifeld. And coming up, retail results ramp up. Target gets a new CEO while Lowe's makes a big deal.
Suspense builds for Powell's Jackson Hole speech as the Fed chair faces challenges on multiple fronts.
And tech troubles. The Nasdaq struggles to recover from its second biggest one-day drop since April's tariff shock.
All right, and we have some breaking news as well on Citigroup. The firm hired law firm Paul Weiss to investigate complaints about the behavior of the bank's wealth management chief, Andy Sieg. He was brought on by Jane Fraser and is seen by some as a potential successor, but there have been complaints that led to the head of HR calling Katie for a probe by this law firm.
And we should say that this is according to people with direct knowledge of the matter. Apparently, Sieg has drawn complaints from current and former staff accusing him of intimidating and unfairly sidelining employees since he arrived almost 2 years ago. Those include allegations of expletive-filled rants and sarcastic comments.
And sarcasm, as we know, is the lowest form of wit. It's not entirely clear what the outcome of the investigation was, but it does look like the law firm's inquiry is now complete. The bank declined to comment on the outcome of the probe. Sieg didn't respond to requests for comments either. Let's bring in Bloomberg's banking reporter Todd Gillespie, who helped to break this story. So, Todd, it looks like this guy had a lot of HR complaints, Andy Sieg. HR called in a big law firm, Paul Weiss. They've done an investigation. Their investigation is complete, and now we're just waiting for the outcome.
Well, I'm not sure the outcome will ever become public, Matt, but what we do know is that, at least 6 managing directors at Citigroup complained about Sieg's behavior. We're talking about...
Managing directors?
Managing directors, yeah. Managing directors. In particular, one of the focus of their complaints was his behavior towards senior female executives at the firm, including Ida Liu, one of Citigroup's most prominent executives who suddenly left the firm in January of this year. She was there for 18 years and ran the private bank when Sieg arrived at the firm. She left in January. Another cause for concern is his treatment of Kristen Bitterly, who remains one of his current direct reports and runs one of 3 core businesses in the wealth division. It's important to note that Citi, that the performance of their wealth business has improved under Andy's leadership. They posted record second quarter revenue, and the bank seems to be standing by him and say that they look forward to continued business success under his leadership.
Well, that's the thing. I mean, put the wealth management franchise into context for us. We know that that has been a priority for Jane Fraser, and as you report, they're standing by Andy Sieg. It seems to appear that way. But this certainly seems like a setback.
It certainly does seem, yes, like a setback. I mean, I think what this shows is that there were, and maybe still are, key tensions at the top of this wealth business right now. Wealth is the smallest of Citigroup's 5 businesses, but one of the fastest growing. Jane Fraser has made it a key priority for her big turnaround plan. She's hired big external hires, Viz Raghavan to run banking, Tim Ryan to run, the company's beleaguered technology, and Andy Sieg was really the third other big key hire here. It's been less than 2 years since he arrived at the bank, and you already have, an external investigation into his behavior, despite very strong, initial financial results from the business that he runs.
So, obviously, it's a big problem when that many managing directors or any managing director takes you to HR. Obviously, it's a huge problem if you're seen as belittling, especially singling out your female colleagues. Expletive-filled rants and sarcasm seem like par for the course on Wall Street. Is that not the case anymore?
Well, here, I mean, it's more than that as well, right? We have evidence here that his COO of the business instructed a managing director to exclude Ida Liu from key information, from correspondence that was key to her business, appears to be undermining her and her, her ability in her job. We also note lower down in the story that he after ranting at a male managing director, reduced him to tears. This seems to be rise to a level that is not just traditional Wall Street. And maybe let's also say now, Matt, we're in 2025. What's deemed acceptable on Wall Street, this kind of behavior perhaps was more commonplace in the 80s and 90s, and maybe some of the the older viewers on Bloomberg TV might know that well. But in today's environment, particularly when you're leading a global wealth management franchise, at a bank that prides itself really, its reputation on being, a little bit better on the HR side of things. Citi is one of the more flexible banks when it comes to, working remotely. Jane Fraser, as Wall Street's first female CEO, has talked a lot about inclusivity. Obviously, like every bank, it's had to roll back some of its DEI initiatives in the wake of the Trump administration. But really, the finance seems to have gone beyond this kind of behavior.
Right. Although I can think of recent examples when expletives were dropped by big executives on Wall Street talking about remote work specifically. But I get 100% your point, and this is definitely a matter to be taken seriously, and it'll be interesting to see if these results come out. Todd Gillespie, Bloomberg's banking reporter, talking to us about this Citi news. Meanwhile, legendary investor Howard Marks of Oaktree Capital told Bloomberg that stock valuations are starting to become worrisome.
The fluctuations of the market are mostly related to psychological fluctuations, and people go from neutrality to liking stocks, to liking them a lot, to liking them a ton, to liking them too much. And that's the continuation that creates bubbles. And, we're probably in the early days of that.
Joining us now is Miller Tabak, Chief Market Strategist Matt Maley. And I mean, when you're hearing this from Howard Marks, who tends to be very conservative about, times to invest, you've got to take it seriously, right?
Oh, definitely, Matt. I mean, and there's no question that the valuations are extremely high. I mean, a lot of people talking about AI and how that's going to change it and make these valuation levels, these extreme valuation levels, okay or justified. But it's not just the PE ratio, well above 22 times earnings. I mean, you have price to sales well above 3 times and price to book more than 5 times. So, I mean, valuation is a horrible timing tool, but it matters eventually. And even though, Mr. Marks did say that, that doesn't mean we're necessarily in 2000, we might be in 1998. But it's something that people definitely have to be aware of. And because, it has to be different this time. And I've been doing this a long time, and it never turns out to be different this time.
All right, so valuations, they don't matter until they do. It's the same thing with Treasury auctions, but let's talk a little bit, actually, Matt, about what happened yesterday. We saw that big drop in tech. We certainly haven't seen that for a couple months now. You write in a report this morning asking the question, was yesterday's drop in tech another mild hiccup or something more? And I'll ask you the same question.
Yeah, well, obviously you're looking over here at the market, what it's doing right now. We're seeing some downside follow through, and that is definitely a concern, especially because we're heading into this seasonally tough time for the markets. I mean, we all know September is the worst month of the year, but it usually tops out in the second half of August, which almost looks like we're doing now. And of course, it tends to bottom in October. So that will kind of lead to some of this, growing fear. And we had this 2 or 3 day hiccup at the very end of July and then early August, but it bounced right back. Can this one bounce right back? Right now, we're not seeing it. So I am a little concerned that this could be a bigger problem.
We're starting to see the market price in a lower and lower probability of a rate cut in September, still 85%, Matt, but what would happen if the Fed does not cut rates? What happens if Jerome Powell signals that they're not leaning that way on Friday? Does this market have that priced in?
No, it definitely doesn't matter. I mean, you see what, they've spent a lot of time in the last couple of weeks, with the Fed speak, pushing investors to think that they're going to be at least a 25 basis point cut. And for a little while there, people were saying it could even be 50. That seems to be off the table. But the market has definitely been priced in for that. And so if Chairman Powell does change that and becomes much more hawkish and signals that there's not going to be one, the market's not ready for that. And this decline we're seeing in the last couple of days will definitely accelerate.
Well, I think we're, 85% priced in for a cut in September. So let's game plan a little bit. Matt, let's say that maybe Jerome Powell did lean hawkish. Let's even extend that further and say maybe they don't cut in September. What would that possibly look like in markets? What area of this market needs rate cuts the most at this point?
Well, I mean, you needed a couple of the two key areas. Of course, the key leadership is the tech group, and we were a lot of talk recently about how it's okay. We'll see some rotation, out of tech and into other groups. Now that only works if we see if the tech group is either rallying slightly, lagging, that's okay, or moving sideways. But if it's going down, it's way too highly weighted in the major averages for the major averages not to go down if they go down. And if the averages go down, people start pulling their money out of the market. They don't rotate into other groups. They rotate into cash, which is actually paying something right now. But we also, of course, have a lot of the financial stocks have been doing quite well lately. But a lot of that has been based on the assumption that we will get some rate cuts. That doesn't happen. That creates some problems for that leadership group as well. So those are the ones we're going to be watching very closely. And of course, tech has been king for a while now, and so we have to continue to focus on that.
Absolutely, but the siren song of cash, it just continues to get louder. Matt, great to get some time with you. That is Miller Tabak, Chief Market Strategist Matt Maley. You take a look at the market right now, certainly a lot of selling. The S&P 500 down 0.8%, close to session lows. Now coming up, Sarah Wolfe of Morgan Stanley joins us to discuss her outlook as President Trump calls for Fed Governor Lisa Cook to resign. We'll unpack it all next. This is Open Interest. President Trump continues to ramp up scrutiny on the Federal Reserve, now calling for Fed Governor Lisa Cook to resign. His comment comes after the director of the Federal Housing Finance Agency called for an investigation of Cook's mortgages. Michael McKee, he is Bloomberg Chief Economics and Policy Correspondent. He joins us now from Jackson Hole, Wyoming. Mike, what do we know so far about these allegations?
Well, FHFA head Pulte, who has been one of Trump's attack dogs in going after people from the Biden administration, has given documents to Attorney General Pam Bondi suggesting that Lisa Cook took out a mortgage in 2021 in Ann Arbor, Michigan, pledging to make that her first and primary residence. Then a couple months later took out another mortgage in Georgia with the same conditions, that it would be her first and primary residence. And according to Pulte, that would be a crime. So he has asked the Attorney General to investigate Cook. No response yet from Cook or the Fed. But one of the things that seems to be motivating this is a desire by Donald Trump to get the seat open. He's calling on her to resign. Pulte says there's reason for her to resign because then he could appoint someone else. It's not like Lisa Cook would have a huge amount of influence over whether the Fed cuts interest rates, which so far has been Trump's main focus when going after the Fed. But right now, this is just in the beginning stages of a news story, and we have to wait and see what Cook or the Fed will say about it and if Trump continues to beat on this drum.
They've also used mortgage fraud allegations to go after other opponents. Adam Schiff is one I can think of. Letitia James is another. Is this public information that they're accessing, and what kind of results has the Trump administration had with these attacks?
Well, that's an interesting question, Matt, and we're looking into it. We don't know where he's getting this information. He would have to look at the actual mortgage documents, and we don't know whether the FHFA has access to those or how he would access them. Cook and others on the Fed file regular financial disclosure reports, as do all federal employees. But at this point, we don't know why or how he got a hold of this information. So that is something that is also less discussed. So far, James and Schiff have said they will fight all of this, and they're not going to resign.
All right, Mike, thanks very much. Michael McKee there reporting live from Jackson Hole, Wyoming. He's there, obviously, for special coverage of the Fed meeting on Friday and interviewing other Fed participants on the run-up to that. So stay tuned for more coverage from Mike. Sarah Wolfe, senior economist at Morgan Stanley Wealth Management, joins us now. And Sarah, great to have you here in studio. Obviously, the Trump administration is looking to push rates lower. The market is pricing in rate cuts. Still, 85% chance of a rate cut at the September meeting, even in the wake of inflation data that continues to move higher. Core CPI was 3.1%. Core PPI was 3.7%. Can the Fed cut into rising inflation?
I think we're going to get a cautious cut in September. To your point, there's a mix of data. So the CPI is definitely starting to accelerate, but it's better than feared. We haven't seen that full price pass through yet. On the other hand, we got PPI data last week, which is showing more input price pressures, and that's going to put pressure on margins and eventually pass through into CPI. And the retail sales data was pretty solid last week as well. So definitely a mix of data. But if we think about what the Fed's increasingly concerned about, it's the labor market. And we haven't heard from Powell since we got the July payroll report. This Friday, Jackson Hole will be the first time that we hear from him. But if we think back to Powell's previous comments, even before July payrolls, he did view risks to the labor market to the downside because he said the unemployment rate is only low because we're losing supply and demand, which means that if supply stops falling, that's when we're going to get that acceleration in the unemployment rate. So they need to be very cautious about how they approach the labor market side of their mandate.
I want to talk about what happens beyond September and specifically what happens next May when we get a new chairperson of the Federal Reserve. We were just talking about, of course, that pressure campaign that it seems that President Trump is ramping up, not just only on Jerome Powell, but now targeting governors as well at the Federal Reserve. It seems like the narrative that continues to solidify in markets is that the president will nominate someone who is sympathetic to his views, and as such, you would expect to see rates drop dramatically come May.
Well, it's going to be a mixed picture, right? So even if he's able to push the agenda of lower short-term rates, perhaps by getting Steve Mirren on the board before the September meeting, replacing Kugler, Cook, Chair Powell, it's going to make investors worried. So we're going to see that priced into the term premium. So longer run rates could actually move higher. And so it's not for free that you get to push down interest rates if the economy is not ready for it. Someone's going to have to pay for that lack of confidence in U.S. financial institutions.
Yeah, I wonder, even if the Fed does cut rates at the very front end, if you have problems trusting the BLS, if, global investors are less willing to buy treasuries. I mean, it doesn't necessarily bring rates down at the longer end of the curve. How often do you see the longer end moving in the reverse direction of the front end? I mean, the Fed funds rate.
Well, it's not very often, but we're seeing it increasingly right now because the dynamics are pushing towards lower short end rates, but then on the longer end, less confidence in inflation expectations long term, debt sustainability, and our financial institutions. And what we've seen, if you look at studies across other countries, when there's not confidence that the data is independent. So, for example, in China, where GDP data constantly gets overestimated by the government, that gets reflected in financing costs, higher financing costs that people have to pay for. So there's definitely a trade-off when you remove data independence, when you remove Fed independence, that's going to have a long-term hit to the economy and the private sector.
Well, back to your question, Matt, I feel like we actually saw that happen last September. You saw the Fed cut rates. I think it was their
True.
50 basis point cut. The long end took off, at least when it comes to 10-year Treasury rates. It was pretty startling at the time, Sarah. And you think back to that cut, with the benefit of hindsight, does that look like a policy mistake? Why did the Fed deliver a 50 basis point cut in September 2024?
Well, we got bad jobs data last summer, and there was a lot of concern. I mean, that's a big question right now, right? Because we're going through a rough summer of jobs data as well. We basically had below 20K in April and May jobs, and then a soft June and July report as well. And so this gets back to last year where we had bad jobs numbers, the Fed cut by 50 basis points, and then everything reaccelerated into the fall. So is there a bit of a seasonality question again?
Yeah.
In my view, I think that the seasonality issue is probably less bad than last year. We were moving out of a lot of the labor shortages, and so the seasonal adjustment to account for those shortages was too dramatic, whereas right now, the labor market is more in balance. So I'm less optimistic that we're going to get that reacceleration. The last thing I'll mention is what I think is happening in the jobs numbers and the revisions is reflecting this K-shaped economy where small businesses are being disproportionately affected by tariffs, disproportionately affected by a softer consumer. They're not benefiting from this whole AI CapEx story quite yet. And that gets reflected in revisions because the second and third jobs reports that you get show more of that small business environment as opposed to large businesses.
All right, well, we'll have to see if history repeats itself. Sarah, great to get some time with you. That is Sarah Wolfe. She is senior economist over at Morgan Stanley Wealth Management. Let's switch gears here and get to today's big take. Bloomberg looked at the full cost of ousting a CEO, similar to what we saw Nike and Starbucks do in recent years. Now, these findings could be a shocker to shareholders, and I'm pleased to say that Bloomberg senior management and work reporter Matt Boyle wrote that story. He joins us now. So when you crunch the numbers, what is the true cost here?
Yeah, I mean, the interesting thing was I never saw anyone actually crunch all the numbers before, Katie. I mean, you see an announcement of a CEO changeover, and sometimes if you dig through the filings, you might look at the severance payment that the outgoing CEO gets. You might see the big salary and bonus that the incoming person gets. But a lot of that is hidden in very convoluted executive compensation language that your layman doesn't really understand. But I knew there were other costs. You have to hire advisors, lawyers, PR people, executive search firms to find the new CEO. There could be a hit to morale and productivity among the rank and file. There may be a hit in the C-suite. Other C-suite members, your CFO, your COO are going to start worrying, wait a minute, is the new person going to like me? Maybe I should leave as well. And then you might have to pay those people to hang on for a little while longer, what's called the retention bonus. You might need an interim CEO, someone to just sort of hold the fort until the new person gets there. So I thought I'd take a look and try to get at least some ballpark estimates, because some of these are very hard to get. They're very obtuse. And put some numbers down and see where we went. And it turned out really interesting.
Yeah, I thought it was a fantastic article and fascinating to see, first, that you rounded up all the costs that you would need to add together. Obviously, some of them are difficult to get exactly right. And we won't even know, for example, in the case of Starbucks until like next year, yes, how much they had to pay Nir Simon really to leave. But what did you get to in terms of a ballpark total to get rid of him and bring in Brian Niccol? And, I looked at the stock as soon as I was halfway through your story and saw that Starbucks has gone absolutely nowhere since Niccol has come in.
That's very interesting. Usually, Brian Niccol came in, and yes, he was a rock star CEO. He was who Starbucks wanted. But they had to pay a lot of money to Laxman to leave because he was only there 17 months. He still has some 3-year performance targets that we won't know the value of until another year or so. And then he brings in a new CFO, Kathy Smith. Again, a great hire. That's $11.4 million just to get her in the door. I'm not even talking about her first year salary or her first year bonus if she does well.
Or the private jet to and from wherever she prefers to work.
At the end of the day, I came up with a calculation of $130 million for this CEO changeover. Now, most of that was the $90 million they gave to Brian Niccol and sign-on bonuses and what they call make-whole payments, which is a very jargony term, which just means the amount of money you got to pay what that person was due at their old CEO job to wrench them out of that job and into your company.
Yeah, it doesn't even calculate what Chipotle had to pay for the loss of Brian Niccol and their new CEO. It's a really great story, Matt. I recommend everybody check it out on Bloomberg.com. You can find it on your Bloomberg terminal as well. Type NI Big Take Go to find that. Let's get a check of the markets right now. You can see that we continue to fall further now at session lows, down 0.75% on the S&P 500.
And what sticks out to me is that if you take a look at trading volume right now on the S&P 500, we're 19% above the 20-day or the 30-day average, So people are selling with conviction right now in this trading session.
and as we, in the lead up, I should say, to Jackson Hole, which is to me so interesting. I thought we were in wait and see mode.
I know.
Right? And that seems to have turned around as all of the Mag 7 stocks are on the sell side of the ledger. Coming up, online marketplace Udemy is transforming into an AI reskilling platform as college graduates find it difficult to get jobs. We'll talk to the CEO, Hugh Sarrazin, next. This is Open Interest. All right, the latest labor data shows young college graduates are falling behind. The unemployment rate for recent grads, which is defined as ages 22 to 27, is at nearly 6%. That's 2 points higher than the national average. For more on the challenges in the labor market and really what to do about it, we're joined by Hugo Sarrazin, Udemy CEO. Udemy is an online learning and teaching marketplace. And Hugo, it's interesting. We were talking with one of our younger colleagues here, and she said, oh yeah, a lot of my friends graduate from college, can't get a job, and they use this platform to try and retrain and get some skills that are useful. Is that what you're seeing?
We're seeing that in spade, and one of the biggest, we're an online learning platform today. We're pivoting to something we'll talk about in a second, but we have 250,000 courses. We covered the gamut, but what's really popular at this moment in time is obviously AI. What to do with AI, how to position yourself and be relevant in this market. And a lot of new college grads and people who are shifting careers are using this platform to help them in their career.
Well, I was going to say, it's not necessarily just college graduates that seem to be struggling right now. I have to imagine that it's mid-career professionals as well who are having a difficult time in this labor market.
Absolutely, absolutely. We're seeing a lot of people who are making important career switches, and we have really interesting learning programs, assessment and partnerships that help people make those transitions very, very effectively.
I wonder about the kind of education that you give on this platform, because you have a serious education. After your bachelor's at University of Ottawa, you went on to get a master's and then a PhD at Stanford. How has that and your 26-year career at McKinsey influenced what you put on this platform?
Listen, I'm passionate. This is a company. It is a product that can influence so many people's life, and I think education is it's the heartbeat of the economy. And yes, there's lots of really important things that are happening with AI that are transforming industries after industry, but it's so important that we stay focused on making sure people have the skills to be successful. So I'm so proud of what we're doing at Udemy. We have part of our platform is focused on the consumer, so people who personally want to take control of their career and make some advancement. But we also serve large enterprise. We have 17,000 large enterprise who are investing in their people and who are trying to make sure that they're ready for what's coming next. And being part of that is just so exciting. And there's lots more that we're doing right now as we're pivoting from being purely an online content provider, which is good, is powerful. But now with AI, we have the ability to personalize your learning journey. We can adapt. So you and I may want to take the same class, but we may not have the same starting point.
Right.
And we may have a different learning preference. And AI allows us to adapt and customize, personalize that learning experience for you.
Well, Hugo, let's talk a little bit more about your offerings here. Of course, you're a reskilling platform. Give us an example of some of the courses that you do offer, and also if you have any idea of what success rates look like.
Yeah, so we have on the both on the consumer side and on the enterprise side, one of our really most relevant offering, and we have almost 5,000 classes on AI. Everything from basic AI fluency, prompt engineering, to vibe coding and how to use DeepSeek, how to use open source model. I mean, we've got the whole gamut. We do it by function and how to use AI in marketing, how to use AI in HR and finance. So a lot of really relevant classes. We also do a lot of certification. If you want to get certified in cybersecurity, if you want to get certified in AWS and Google and everything. We've got 60 different types of certifications, so very much helping people achieve mobility in their career. And then it leads to certifications and tests and exams that they can take to demonstrate to potential employers or existing employers that they're progressing. And the success rate is actually quite high in having that people be able to take these exams and pass this exam and change their careers.
I look at your revenue continues to climb over the last 5 years. You went from making losses to profitability, and yet the stock chart, Hugo, is bad. You're down 76%, I think, since the IPO. What are shareholders getting wrong, or what can you do to turn this around?
Yeah, I think at a macro level, as you noticed, the IPO happened during COVID. It was a very special moment in time where a lot of people were sent home. A lot of companies like us came out in the market because we were benefiting from that tailwind. And after that, there was a repositioning of the demand for this, and that has spooked some investor. We also have an overall negative sentiment on online learning. And that's why, I think what's really exciting, and the reason I came here to be the CEO, is we have the opportunity to take online learning, which was an amazing idea 15 years ago. It delivered a lot of amazing benefit, but it fell short of the full potential of online learning and education. Now with AI, we can pivot. So we're sitting on 17,000 large enterprise, 80 million learners, 250,000 courses, and now injecting AI and doing things like what we're doing. We're doing online simulation and role plays. We can help learners get to the next level. So this is what's really exciting about what the future offers for us, and we're the first one to sort of move away from traditional online learning to this AI reskilling platform. We're doing it with a really healthy balance sheet, $400 million of cash, and we're gonna shape the way this market is going to be defined moving forward using AI.
All right, Hugo, great to get some time with you. Really appreciate it. That is Hugo Sarrazin. He is the CEO of Udemy. Let's get a check on these markets. Just over an hour into the trading day, you can see that losses deepening on the S&P 500, on the Nasdaq 100. It's really a continuation of what we saw yesterday. It's interesting to take a look at the sector breakdown here. You can just tell from, of course, the indexes themselves that this is a risk-off market, but that certainly comes through when it comes to the sector levels as well. Your best performing sector right now, consumer staples. That looks, of course, pretty risk averse. And then you take a look at what isn't doing well. It's consumer discretionary. It's big tech. So that's certainly coming through, and a little bit of a bid coming into the bond market as well, Matt.
Yeah, the problem, of course, is that you have the biggest, heaviest stocks all down. Nvidia, Apple, Amazon, Broadcom, Facebook, Tesla, Palantir, Google, Microsoft.
It's almost all of them.
Yes, exactly. Let's get a look at some of the other single stocks moving at this hour. Toll Brothers quarterly orders missed estimates as affordability continues to hamper home buyers, and I'm sure that rates don't help either.
No, not at all. Estee Lauder also issued a weak profit outlook for its fiscal year, dragged down in part by tariff costs, certainly something we've heard before. Shares down about 5.7%.
Hang on, Toll Brothers is up.
Yeah,
Didn't I just say it issued a disappointing?
Yeah, well,
not that disappointing.
Well,
apparently.
the market, of course, is taking something else.
In a down market, they're bouncing. Hertz is surging on news it will sell cars on Amazon Auto, and you can see the gain there, 6%. Speaking of autos, later this hour, we're going to bring you part of my interview with Ford CEO Jim Farley as the company looks at developing a supercar for off-road racing.
I didn't know there was a thing, off-road racing. I thought that was like motorbikes.
No, it's like Baja 1000, like Dakar. He says he wants to win the Dakar more than he wants to win at Formula One.
Wow.
Up next, this week's retail earnings continue to roll in, and it's been a mixed bag. We'll break them down with analyst Michael Baker of D.A. Davidson. This is Bloomberg.
Target announcing changes at the top, the company picking its COO to be its next CEO and turn the company around. Shares plunging on that news. Joining us now is Michael Baker. He is senior research analyst over at D.A. Davidson. He has a buy rating on this company. Great to have you with us. Would love to first off hear your reaction to these C-suite changes, given that just taking a look at the shares, it's not being greeted with open arms here.
Right, and we did expect an announcement of a new CEO at some point this year. We knew Brian Cornell was getting set to retire. I think Michael Fiddelke has done a good job in some of his roles at the company, and we appreciate giving him time to turn this around. I think the issue today is more just about a near-term catalyst, a pop in the stock, if you will. I think there was some hope that if Target made an announcement of some known brand name CEO, someone who had maybe turned around a company somewhere else, there were a couple names out there, you would have gotten that sort of one-day pop that you've seen, for instance, when Starbucks hired away Chipotle's CEO, something along those lines. And so just the lack of that, I think, is why the stock is down today. I don't think it's necessarily an indictment of Michael Fiddelke. I think it's more that the market was hoping for that catalyst. That catalyst is now behind us. Didn't happen in terms of picking off someone from another firm. But the fact is, the numbers that Target reported today, while not good on an absolute basis, were better than expected and were better than the previous quarter, and you're starting to see some progress. So I think that augurs well for Michael Fiddelke.
Well, Michael, you said the word turnaround, and I want to talk a little bit more about that. You take a look at shares over the past 5 years, down 27% on a total return basis. Certainly seems like a company that is in need of a turnaround. What would you like to see this new CEO do in his next 12 months?
Yeah, and I think Target has been impacted by a couple things, some internal, some external. Target does focus more on discretionary products. And it's really the non-discretionary basic type of things that have done better in the post-COVID era. So we are seeing, strength in grocery stores or auto parts retailers or Walmart or the clubs, and less so in discretionary retailers. So some of that is a little bit out of their control. But some of it is execution, and Target has certainly made some mistakes. They seem to have to be heavy in inventory when the market it wants to be light in inventory, and vice versa. So there's been some issues. What we'd like to see the new CEO do maybe a little bit better is just be a little bit less accident prone. Again, there just seems to have been some mistakes that the past administration has done. We do think we'll see a continued focus on discretionary product, and probably even more so. We think Target has an opportunity to differentiate with style and fashion and things that they've historically done well. Just continue to lean into that. And then lastly, I do feel like some of the store operations and store standards have fallen over the last few years, and so that's going to be a big area for Michael Fiddelke to get back to really running the stores a little bit more sharply.
What would you do, Michael, if you were in charge of Target and could make one major change? I mean, is there one major issue that he has to pay attention to?
I think it is that store operations. I think what we've seen in stores is a lot of out of stocks over the past year plus. The service hasn't been as good as it has been in the past. Messy stores. Stores that don't look as sharp as they could. So I think if they tightened that up, that would go a long way. Merchandising could always get better. I think Target really made its name by focusing on style and fashion and differentiation and all those kinds of things. That gets harder every year because everyone else is trying to do that as well. And Amazon has great merchants, and Walmart has good merchants. Costco, phenomenal merchants. So Target needs to keep elevating their bar in terms of merchandising and differentiation and fun. And it is something they're focusing on. We did see, again, the same-store sales get less worse, so there seems to be some progress there. But if I were to name one, really, it is that store operations, in-stock, cleanliness, customer service, et cetera.
And I want to switch gears here and also talk about Lowe's. Lowe's out with earnings, also news of an acquisition. So you have a neutral rating on Lowe's. You have a buy rating on Home Depot. We heard from that company yesterday. It's interesting to see that because you take a look at how these companies have been performing against each other, and Lowe's has been the winner over the past 5 years, outperforming Home Depot. Do you see that switching? Do you see a handoff in leadership here?
Well, we have seen that handoff really. If you look back to go back to 2018, when Lowe's hired Marvin Ellison, who was one of the top executives at Home Depot and then was CEO of JCPenney. That was in 2018. The margin gap between Home Depot and Lowe's at that point was about 700 basis points. Home Depot was just killing Lowe's. Over those 6 years or so, from 2018 really through mid-2024, Lowe's was closing that gap. And over that time, Lowe's stock was outperforming. And we were big backers of Lowe's. We had a buy rating on it and rode that all the way up for 6 years in a row. Lowe's outperforming Home Depot in terms of the stock as that margin gap closed. Give Lowe's credit, they actually almost fully closed that margin gap. And then beginning in about mid-2024, the leadership in terms of the stock price changed, and Home Depot outperformed Lowe's for the first time in 7 years last year. Because that margin gap story had already played out and that was no longer a catalyst for Lowe's. In the current environment, we do have a neutral on Lowe's. It's more about there still being a lot of risk in this environment, so we're sticking with the best in breed in that space. We call Home Depot, internally we have an initiative called Best of Breed Bison. So we're sticking with the best of breed name. That Bison, by the way, you can see the logo behind me, plays in our roots as a company based in Montana. But so we do prefer Home Depot at this point. Lowe's, the two stocks have been about even year to date. Lowe's has done a nice job as well. In fact, they outcomped Home Depot for the first time in a couple quarters this quarter, but Home Depot is our preferred name right now.
All right, Michael, thanks very much for joining us. Michael Baker there of D.A. Davidson talking to us about the retailers. I want to quickly break a headline that President Trump is now saying, at least according to the Wall Street Journal, he's going to consider firing Lisa Cook from the Fed for cause. This, according to the Wall Street Journal. We know earlier that he tweeted out that she should resign, but the Journal now saying that he's considering firing Lisa Cook from the Fed for cause.
Yeah, so taking it a step further there, of course, we'll continue to follow that story and bring you any updates as we have them. But again, according to the Wall Street Journal, President Trump considering firing Lisa Cook, the Fed governor, for cause.
Coming up, Ford is looking at developing an off-road supercar, like a GTD for the dirt. That's part of our interview with CEO Jim Farley on our podcast, Hot Pursuit, with Hannah Elliott. She joins us next. This is Bloomberg Open Interest.
I'm very interested in that. The off-road, the on-road performance hierarchy is very simple to see. And the very top is overserved, in my opinion. And no one's ever done an off-road supercar.
That was Ford CEO Jim Farley teasing the possibility of developing a supercar, or even a hypercar, if you will, for off-road racing. He spoke on our podcast, Hot Pursuit, with Hannah Elliott. She is a staff writer at Bloomberg Businessweek, joins us right now from Los Angeles. And Hannah, this was super exciting. You were in Monterey with Jim Farley after he'd finished judging the Concours d'Elegance at Pebble Beach, and he was really jazzed about the idea of going deeper and deeper into this market that Ford has already probed.
Yeah, I was really surprised. Jim Farley, of course, is like the ultimate car guy. He really bleeds for Ford and for cars. We know this. And I was really surprised. He used the word nauseated. He said he was nauseated with the state of the supercar segment these days. He just feels that they are all growing rather boring. And he started talking about this idea he has to make a supercar that can go off-road. You know, and it reminded me, oh wait, the Ford Bronco is the only production vehicle that has won the Baja 1000, which of course is that off-road race down in Mexico. So I'm thinking, you know what? This is all connected, right, Matt? Is that what you were thinking?
Yeah,
when
I
you
was
heard
thinking,
that?
yeah, absolutely. I mean, not only did they win the Baja, but they have developed also the Bronco DR, which I think stands for Desert Ready, right? And that was already super cool and out there, but they only made 50. Plus they have the Raptor R, which is this, 800 horsepower supercharged fire-breathing V8 behemoth that people are willing to shell out well over $100,000 for. And it just made sense, but it also is kind of counter to his day job, which is providing people like cars to get from A to B for not too much money, right?
I know. I thought this was such an interesting juxtaposition between the recent news we've seen of Ford making more affordable platforms, more affordable EVs, trying to get around the $30,000 price tag. That is also true. So now we're having Ford, try to own both ends of the spectrum, maybe. Which could be great. I will say, when Jim Farley says, no, we have no supercars that go off-road, I think Lamborghini and Porsche may raise their hand and say, we beg to differ a little bit, of course, because Porsche has done Baja-style 911s, and Lamborghini has done sort of off-road Huracans. But it does sound to you're laughing.
Well,
to
because
your point,
go
ahead.
The Huracan Storado, which is an amazing, $450,000 car. If you can get one. When I was test driving it, they said, "Now you're not allowed to take this off road." So I think Jim Farley means something that actually really and truly goes off road and can be abused, right? He wants to win the Dakar. I thought that one of the most interesting things he told us, Hannah, was that Dakar is more important to him than F1.
I couldn't believe it. I think he was really amped up on just having a huge car day. We were at Monterey Car Week. As you know, he had actually just won his race at Laguna Seca the day before. So I think he was really amped up and he was ready to go. And I couldn't believe when he said that. It's just so interesting. It was honestly kind of inspiring to see him call out some names. He called out Porsche, like you say, he's saying F1, he'd rather have an off-road title. It was exciting.
It was a moving interview. And Hannah, thank you so much for getting that interview. I highly recommend that people check out our podcast. You can hear the full interview on Hot Pursuit. Get it on Bloomberg.com or wherever you get your podcasts. This is Open Interest.